Welcome to Vortexa Energy Insights, the monthly podcast created by Vortexa market analysts to give you the latest on what has moved the markets, why it matters, and what the data is telling us for global crude and refined product markets. My name is Pamela Munger, Head of Market Analysis for Europe, and I am your host for today. We will generally bring on industry experts and Vortexa in-house analysts to explore topics further to give you the data related to what is happening in the energy markets. And today, we are very proudly joined by David Wech, our Chief Economist and legend in the oil markets. Thank you very much for joining me, David. So let's just start off by looking at reviewing perhaps what are the most important headlines from the last week or so? Well, certainly there's been some changes in the U.S. policy, which is driving more uncertainty in energy flows. What do I mean by that? Well, on February 20th, the U.S. Supreme Court struck down President Trump's wide-ranging tariffs on foreign imports, and the administration responded very quickly by invoking a different trade article to impose 10% tariffs on bilateral trade beginning February 24th. And this allows an increase to a maximum allowable percentage of 15%. Now, while the tariffs continue to exempt energy flows, it raised a lot of questions on future bilateral trade deals between various countries, namely India, because of the changes we've seen recently, as it could give India an opportunity to purchase, again, deeply discounted Russian barrels. So far, we've noticed that Russia crude flows to India have largely been redirected to China over the last few months, with the exception of a few recent February cargoes, and of course, Russian imports into the Nayara refinery. Of course, the question is how will this change going forward if tariffs can no longer be used by the U.S. as a bilateral trading weapon? David, do you have any thoughts on this?
Yeah, I think as you say, the crucial country probably to look at is India. I think it was the main question for the oil market so far this year, whether India would cut Russian oil exports, as President Trump has communicated. Yeah, the Indians have never confirmed that. And I think with the Supreme Court decision, the power of Trump over India is drastically reduced. And I have generally been skeptical about this statement or this direction, because the relationship between Russia and India is a very important geopolitical one. And if India would allow basically the US to determine its interactions with other countries of that importance, it would be a substantial geopolitical move and change, and it would be highly relevant for the oil market, because the point is, even though China has surprised strongly, I would argue, over the last couple of weeks with taking in a lot of sanctioned crude, highly discounted, both from Russia and from Iran, China cannot absorb all the volumes that India has been taking from Russia. And over the last 2 months, India still took 1 million barrels per day. It has been down to about half the volumes beforehand, but it was still a full 1 million barrels per day. And I think the likelihood is now more that actually this will gradually go up again over the coming months. And that basically means for Russia and Iran that in all likelihood they will continue to have sufficient outlets, even though it's a very tough battle. And evidently both Indian and Chinese buyers are enjoying these massive discounts on a loading port basis in the Western European part. Euros and other Russian oil is now discounted by $30 per barrel relative to Brent, and that's evidently massive. And on a delivered basis, there are still big discounts these buyers are enjoying by taking the sanctioned barrels.
Thank you. And do you think that, just a prong question from that, what about this redirection to China? What are your thoughts in terms of what China can continue to take in from Russia, considering the storage that they're building there and in the particular sectors in which they're building it?
It's one of these other big questions in our industry. How much can China store? How much has China actually stored in the past? On a big picture level, I would like to start with the comment that I really think that over the last couple of months, imports have been running much higher than underlying consumption. Yeah, and that was partly a function of this reshuffling inflows and not being sure whether Indian players, for example, whether they can continue or not continue to buy Russian crude. So they were buying a lot of replacement crude and they're now basically getting again type of double deliveries. China was making use of that. Of course, there is also generally a very strong incentive right now for Chinese buyers to take in as much crude as they can get from sanctioned players because they have just experienced at the start of the year that one of their suppliers, Venezuela, was just taken out by the US. Yeah? So they are clearly aware that this luxury of having discounted barrels may not continue forever. That's one fact. There is another fact, which is the geopolitical concerns or the standoff or how to say, type of escalation between the US and Iran, which is questioning potential supplies out of the Middle East Gulf altogether. So any, how to say, cautious buyer will be interested to take on as many barrels as possible, but in particular, those that have this luxury of the additionally discounted barrels. So the incentives are very high. Until recently, prices have also been very low. The stock building has been relatively significant over the last couple of months, but it has also not gone through the roof. And there is this question how much spare capacity there is in the system. There is also significant new tanks coming on stream. Most of those tanks, however, are owned by the state companies, and the state companies are the hesitant players in the Chinese market. They are staying away from Iranian barrels. They are now largely staying away from Russian barrels. So that limits a little bit the possibility perhaps to fill the storage tanks with sanctioned oil. But the utilization rate of storage tanks in the independent sector, I think, is something like 55%. Yeah, so in theory, there is still about half of the tanks in theory to be filled, but it's one of these very difficult questions. What is a realistic maximum utilization level for the entirety of the storage tanks? Because most of these storage tanks are in commercial operations, so people want to have them ready to fill them temporarily when they have a cargo coming in. So it's not that the idea is that the storage tanks are full all the time. The idea is that they're providing room to manage logistics. Yeah, so it may very well be that realistically you cannot fill these tanks much above 60% utilization on average. Yeah, so but this is a type of unknown. There are different opinions on this. Generally speaking, ultimately, I would argue there is always room for more in China, yeah, if the incentives are strong enough. And currently, they're definitely strong.
Yeah, and my understanding is that we're seeing a large program for Iranian barrels for this particular month. So there's no slowdown in terms of Iranian barrels moving towards China. And my point in saying that is that that's going to keep those discounts quite low. So you have the Iranian side keeping very low discounts, and at the same time you have this Russian flow, which also is keeping oil on water very high, largely because of the logistical constraints in moving those Russian barrels onto non-sanctioned vessels before they get delivered into China. Now,
if I may just come in on there, it's generally fascinating how quickly the oil market is moving. There was a period in January where loadings from both Iran and Russia were really coming down quickly. And the question was at that point of time, is this because these players are struggling to find vessels, or is this because Iran in particularly is not anymore willing to sell the crude at these deep discounts and are therefore cutting back barrels? So there was basically at this point of time the concern that these players would not anymore be able to participate with the full barrels in the market. Fast forward a couple of weeks, and it looks now again, exports from Iran are very high. Exports from Russia have been going up substantially. So basically, now again, it looks like these players are perfectly able to send all the barrels available to the market. And in the case of Iran, we have seen a similar pattern ahead of this 7-day war in, when was it? May, I think, last year or something like this, or June last year. they had also sent out more barrels. Yeah, so they know that there is a threat. Yeah, that their ability to export oil may be impaired relatively soon. So of course they have now this extra incentive to send out as many barrels as possible on a short notice. As do also have other players in the region. So we have also observed increased exports from Saudi Arabia, increased exports from the UAE.
On both sides, right? We've seen out of the ports that are not blocked by the Strait of Hormuz, as well as other ports, correct?
More recently, it has clearly been from within the Middle Eastern Gulf, inside the
Okay.
Strait of Hormuz.
Okay.
So they have
Okay.
maximized the send out from those locations. And yeah, that's at the same time a clear indication that these countries are concerned that the risks are real. Yeah, and if I may follow up, I mean, from my personal perception, the pressure on President Trump has been increased quite significantly over the last couple of months. I would argue the last month has not been a good month for his presidency. And generally speaking, when the political situation for a person like Trump deteriorates domestically, then what are you doing? You're trying to divert the attention to other topics. So I do think that the risk of some further escalation in the Middle East Gulf is definitely higher than it has been before in the Trump presidency.
With that, what is your take on, crude prices kind of edged upward last week, and they're kind of back down, it looks like today. The market is taken out of that back end contango. What are your thoughts in terms of, we've got the sanction flows, high oil on water, but at the same time we have big crude importers like India really pulling on mainstream crude imports. What is how do you marry all that up in terms of the risk premiums and sort of giving a floor to prices?
Yeah, it's a fascinating market because 2026 was supposed to be the year of the big oversupply in the market. If you listen to the forecasts of the IEA as the key agency, but also a lot of the banks and so on with the price forecasts, where everybody was very much on the bearish side. And yes, there is a lot of oil at sea, but the oil at sea is the sanctioned oil, basically, and that's not accessible to most players. If you look at onshore inventories around the world, except China and India, stocks are actually very low from a historical perspective. Yeah, so outside these places, people are holding their stocks low. Out of commercial reasons as well, profit maximization reasons. So from that point of view, it's also a supportive type of mix in the market, and we have to see how all this develops. What we can definitely say is that the supply side has been swinging dramatically over the last couple of months. We had extremely high exports last September, October into November. Then they have come down a lot, and that has led to this somewhat type of physical crude market situation. On top of that, you have the geopolitical risks. You have also very high freight rates. So there is generally a very bullish cocktail now in the short term. But what remains and what we have already seen is, yes, there is a lot of supply potential, and OPEC has been continuing to add extra barrels to the market as well. So I do think it's still pretty likely that we see a weakening of the market down the line, because as I said, I do think that over the last couple of months, crude procurement has been driven a lot by supply security concerns and much less by the underlying demand. And if we look at our data from a product market perspective, there is very little indications that oil demand is actually doing particularly well. So the strong oil demand picture really comes from the crude side, but on the product trade side, there are a lot of markets that are importing less motor fuels, in particular, less gasoline. So that's a consistent picture around the globe over the last year or so. From that point of view, these millions of barrels that have been added in terms of crude liftings around the world, it's still a bit unclear whether they will actually find easily homes in the medium to longer term.
With that, the finding homes, just to kind of bounce on one of those major crude exporters, Russia, and the questions that we mentioned about India and the possibility of India looking towards Russia again, possibly in a few months' time. What do you have any thoughts in terms of what Russia crude exports will look like in a few months' time, in terms of the pain that they're going through now?
Yeah, I'm personally convinced that Russia will always export every single barrel of crude it can export because it needs basically every foreign exchange it can get to finance its war in Ukraine. Um, and even if they're huge discounts, they still make money on the oil. Yeah? And they have essentially no real production costs domestically because they only pay, so to say, themselves to get the oil out of the ground. That's the general idea. I would have the question has been, do they struggle in terms of vessel supplies? Sanctions have been steadily tightened over the last year. And there have been periods where it looked like difficult, but what we are seeing is they're always finding new solutions. Yeah, there are always new players coming in. So after the sanctions on Rosneft and Lukoil specifically, a lot of new entities popped up that are officially handling those barrels, for example. Another new feature we have seen is that now historically, the exports from the European side of Russia have always been done on Aframaxes and Suezmaxes simply due to the limitations on the Bosporus and on the Danish Straits. Now we are seeing the increasing involvement of VLCCs, the biggest tanker class, and that happens basically via ship-to-ship transfers. So the first leg out of this water straits basically are done on the typical Aframax and Suezmax vessels, but then there are STSs to the bigger vessels in the Mediterranean or in the Red Sea area. And on those vessels, the oil is then being shipped to China and is then transferred again to another ship. And ultimately, for the importers, it does matter that not sanctioned tankers are not involved. But essentially, you only need for the very last leg of your voyage from the ship-to-ship transfer from this VLCC to a smaller vessel that is then discharging into the Chinese port, a non-sanctioned vessel. Yeah, so you can basically, and we see steady inflow of new vessels into this dark fleet, not yet sanctioned fleet. Therefore, so far, Russia has managed to maintain its flow. They're actually now making use of the vessels that are not anymore used in Venezuela, that have been essentially freed up, so to say, by the US intervention there. At this point of time, I don't see any reason to expect Russian crude exports to fall off a cliff. On a longer term basis, it looks very much like that Russian crude production is declining on a lack of investment in oil fields, but this is a gradual process, not a dramatic or quick one.
Is it true in our data we noticed that not one Russian loaded cargo that discharged into China was discharged on a sanctioned vessel?
The number was very small. Something like 80 to 90% of the discharges were on non-sanctioned tankers with the AIS signal on. Yeah, so perfectly traceable and not sanctioned by the US. Yeah, they don't care so much about the European or the UK sanctions.
No, just the one they're negotiating with. Okay, very good. Thank you very much for that. Are there any questions that you have for me?
Perhaps any quick notion on the product market? Any highlights you're seeing there in the recent development? Is the product market as bullish as the crude market, or is it
well, I think you have what we're looking at is a little bit of a mixed bag. You're still seeing some strength in the middle distillate market, especially for jet, and I think that's widely because you have very few players who make the majority of or produce the majority of jet. So you still see some strength going on specifically there. The gasoline market, as you mentioned, is trending lower. But of course, right now we're in with late February, so the gasoline markets really haven't taken off to the degree in which we would expect them to. Although in saying that, I think we're not expecting a huge rise in demand, certainly in the major demand centers in the Atlantic Basin, such as Pad 1, and of course there's some spotty demand, of course, in the Atlantic Basin as it relates to the Dangote refinery, constantly being up and down. We had seen a slight decline into Mexico East Coast, but that's possibly going to be mitigated by ongoing issues with Dos Bocas and possibly some of the domestic issues that are occurring right now in Mexico. Now on the Asia side, we're moving away from the holiday period, so we're seeing a softening in demand for clean products overall. And overall, the market has been well supplied. So it is likely that wider Arabian Sea arb, especially for middle distillates, kind of swings around and looks to push towards Europe, which could mitigate any further rise in middle distillate margins.
Yeah, what I find fascinating about refining margins basically over the last couple of years is that we have basically net zero addition to global refining capacity. So we have steady growth of crude runs. And with that, utilization rates of the existing assets, which, as said, on a net basis are not growing. A lot of assets are getting older and older. We have all these outages. So that is something that gives regular, repeated support to refined product margins in an basically type of stable demand environment. And so there's always good reason to be bullish on products as well.
Yeah, I agree. We've seen that just recently, sort of intra-European, so Northwest Europe gasoline moving to the Med because of some unplanned outages, especially as it relates to the FCC units in the Mediterranean. So, and just that supply outages has had an impact on clearing barrels out of Northwest Europe, not just for gasoline, but of course for naphtha to blend into the gasoline, especially as petchem margins in Europe are so low. So naphtha has kind of taken on a new charge in terms of being a gasoline blending component, more so than a feedstock for petchems in Europe. Thank you very much, David, for joining us today. And thanks to everyone for listening. We look forward to bringing you more fresh insights in the next month.
Many thanks, everybody. Much appreciated.
Thank you very much.